Hi, everyone. This is Jason Burek of Wall Street from Main Street. Welcome back to another Wall Street from Main Street podcast interview. Today's special guest is a first-time guest, but I was actually on his Twitter Spaces recently. He has a very large following on Twitter, and he does daily Twitter Spaces. He's doing a lot of work for free out there, a lot of great content. He's a 5 times Dow and Founders Award winner. He's created 2 exchange-traded funds, the Risk On and Risk Off ETF, the Junk On and Junk On ETF. Sounds really interesting. We'll have to get his comments about what exactly they do. He's a mutual fund portfolio manager and publisher of the Lead Lag Report. Michael A. Gailly, chartered financial analyst. Thank you for joining me.
I appreciate that. I mean, I think you just reminded me that I need to probably take a vacation with all those things.
Yeah, you've been really crushing it with all the Twitter Spaces. It's a ton of work.
Yeah, I mean, listen, you know it yourself, right? It's one thing is being the interviewee, the other thing is being the interviewer, right? It's a different skill set altogether. I only learned that a year ago when I started doing this daily on Twitter. Yeah, and I'm used to being on the other side of it, right? As somebody who used to do the CNBC rounds and Bloomberg rounds for a long time, but I do think it's when you've been interviewed a lot in your career, hopefully you know what to ask and what not to ask because you know what it's like to be asked things which don't really make much sense.
Well, I have an interesting question since you manage a lot of money. You're a mutual fund portfolio manager. You've also created exchange traded funds that look like they help deal with volatility, asset price volatility with all the craziness that these central banks and governments are doing for years now. And it just seems like it's getting worse. So how do you manage risk with trades or investments in this type of environment with asset price volatility and where central banks can literally change the policy, do a 180 very quickly?
Yeah, so this is a good question, and this I've been really open all year about this point that this year has been, from my vantage point, complete hell. And I say that because, look, traditional finance would argue that volatility is risk. When you look at the history of asset class interactions to each other, if you view risk as volatility, well, usually when you have high volatility in stocks, there are certain beneficiaries, right, that tend to benefit from that volatility as money seeks, less volatile, kind of safer pastures. The three that tend to be sort of those risk-off volatility beneficiaries are the dollar, which has been strong, treasuries, and gold. Now, in my world, treasuries are usually the best place to be because historically you look at major drawdowns in stocks. Historically, you look at high volatility sequences for stocks. Long duration treasuries end up being the flight to safety area to position into, except this year, right? So here I am with my mutual fund, my Rotary ETF, my JoJo ETF. They're rules based. They all rely, based on the prospectus, on long duration treasuries to be the place to park capital in high volatility and high risk for stocks. And instead, treasuries, rather than being the beneficiary of stock market volatility, of stock market risk, ended up being the source of stock market risk. Now, to your question about how central banks kind of play into that, clearly central banks put us in this position in the sense that you probably would not have had such a severe, violent reaction by treasuries, by bond yields, had the Fed in particular done the right thing, which has gotten ahead of higher inflation. It doesn't fully explain the drawdown and the break of the flight to safety trade, but the reality is, the Fed can be a friend and a foe. The Fed, you can argue, has been a friend for a long time. Now it's a foe, and when you're in an environment where everything is acting volatile, it's hard to really manage risk because everything has risk.
Would you say the reason treasuries are not acting as a safe haven for the last 9 to 12 months, would you say it's because of what's happening with these leveraged hedge fund trades that these pension funds have hired and they're getting margin calls and they're having to sell things to raise cash? And then also the normal buyers of treasuries, which are these governments and central banks like China, Japan, Germany, which used to run large trade surpluses and then they'd recycle the reserves into US treasuries. They're not net buyers anymore.
I think there's an element of that, right? And it's as is always the case, right? It's always more complicated than just one variable in terms of explaining exactly why things do what they do. First of all, keep in mind that the drawdown in treasury prices and rise in long duration yields started late July, early August of 2020. So you've actually been in a let's call it rising rate environment from that perspective longer than the Fed has been raising the short end. And part of that should make sense, right? Because the Fed really doesn't control the long end; they control the short end with interest rate policy. Despite what most people on FinTwit would have you believe, the long end is kind of more market driven. I do think you have a point. Look, clearly the behavior this year was very different compared to history in that usually when you have a strong dollar, because foreign money is seeking quote unquote safety, it'll also at the same time buy treasuries. It'll also seek yield. And you didn't have that. Instead, money went into the dollar and basically just sat there, right? As long duration yields kept on rising and as treasuries kept on failing again from, at least this year as the safe play. Now, the thing is, again, it can't be fully explained by the Fed because it started happening before the Fed started hiking rates. Historically, when you look at those major drawdowns for equities, even as the Fed funds rate is rising, there are instances where long duration treasuries still act as the safe haven. Again, this has been kind of the hell of this year for me. Your point about the pensions and leveraged treasury positioning is interesting. I mean, you can relate that a little bit to risk parity, right? Which relies on treasuries as among the asset classes to give you kind of a more balanced portfolio. And the same dynamic that hurt my funds is the same dynamic that hurt risk parity, right? The failure of treasuries to counter equity volatility. I think there's an element of truth to that, but again, I don't think it's the full explanation. And I know it's not a very kind of popular opinion or thought or way of thinking about the stuff, but in any data set, you're always going to have anomalies. You're always going to have things that cannot be fully explained that you can argue are maybe somewhat random. I would put this year, 2022, somewhat in that camp, that this is an anomalous year in terms of the interaction of stocks to treasuries, in terms of the way stocks acted as a standalone, in terms of the way treasuries act as a standalone, in the way that currencies acted. I mean, when you look at the volatility, speaking about risk, currency volatility this year has been almost larger than equities and larger in some cases outright. So a lot of reasons I'm sure that explain this more than just inflation, but it's I guess the way to summarize it is that it's like that old Facebook relationship choice. It's complicated.
So you expect US Treasuries to gain in principal value again. Is a lot of that thesis based on the Fed eventually admitting that they can't raise interest rates anymore, stopping a balance sheet reduction, and then doing a 180 and starting to lower interest rates, headed back towards a zero interest rate policy if there is a worse official recession or depression then?
So to me, it's not so much about just treasuries by themselves. It's really about, I go back to that flight to safety dynamic. So let's take a step back. The term risk off is thrown around a lot in the media, and I think everyone misinterprets what risk off really means. Risk off is not about direction in stocks, about a recession, about a depression, about an expansion. Risk off is about the flight to safety, which occurs when there's high volatility, right? So usually, again, going back to that point that, risk off doesn't mean no risk. It means default risk off, right? Because the argument there is that as there's volatility in asset markets, in equities, typically you see credit spreads widen. Typically, that means high yield becomes riskier because investors start getting a feeling that there's a higher likelihood of them going bankrupt. So they demand more premium. Some money is not comfortable with that. So what does it do? It moves up the quality scale to AAA and ultimately government treasuries or government debt, because the argument there is, at least in theory, the government can't go broke because we're the ones funding it, right? Through taxes. So,
well, the US dollar is also world reserve currency, so it's relative. Right. So are you talking about Argentina selling what? Argentina sold 100-year bonds to suckers, a couple of years ago, and there were actually idiots that actually bought it.
Yeah, no, for sure. But keep in mind, you're correct. There's a reserve currency aspect to it. Although it's interesting because if you look at the way German bunds act relative to the DAX, usually in high volatility for the DAX, German bunds will also outperform meaningfully, right, in that high volatility sequence. Same thing with the Nikkei and JGBs in Japan. So this kind of flight to safety dynamic is not something that I discovered. It's something that's been around for a while. It's kind of well documented. You're right. Obviously, when it comes to emerging economies or kind of third world economies, that dynamic's not going to be there, right? Because that's where the government can default, clearly, right? At least that's the perception. So the broader point here, though, is that my suspicion is that, and maybe this is wishful thinking because I need it for my own funds. My suspicion is that history will reassert, meaning you'll have the flight to safety dynamics kick back meaning that as volatility again goes through another wave higher at some point next year, as recession concerns kick in, as people start realizing that housing is probably cooked for a long time, that you should see treasuries on the long end benefit, all while the Fed is still hiking rates. I mean, essentially making the yield curve even more inverted.
I see. And then this also plays into what you've been posting large threads on Twitter over the last couple of weeks about another imminent stock market crash, because I guess you expect a real estate crash, and then you expect problems with corporate debt. And then also, I think we're going to see earnings problems with profit margins. These companies are still having cost problems, cost pressures, labor prices. So the earnings, there's going to be a lack of sales and earnings disappointments and profit margin pressures.
Yeah, and let's unpack that a little bit, because I always go back to it's not about the call, it's about the conditions, right? So I always go back to you got to focus on the weather and not the mile marker that you might crash, because if it's raining, you want to slow down, even though you're probably going to be wrong the majority of times, and you could have just gone full speed ahead, all along. Now, the look, what's usually the precursor to a major crash? It's illiquidity, right? It's less money in the system, right? Whereas when you have high liquidity, volatility tends to be lower. Liquidity is the answer to high volatility events, right? That's why the Fed comes in and reliquefies after extreme declines. So I look at what's gone on with lumber prices. Lumber, which is a tell on housing, unrelenting decline all year. And housing, people, I don't think the average consumer really understands or appreciates just how bad the housing market is now, because again, you don't have too many transactions in the fall and winter periods anyway, right? So they'll feel it really more in the spring and summer. But housing is in bad shape. That's a massive source of illiquidity. And when I see the sentiment, I do think it is true that you have not really yet fully broken the speculative fervor, which typically ends, in a capitulation type event. I've used that line before. It's not a generational buy until you've lost a whole generation to investing, right? When people get so disgusted by things. So I look at that. I look at the backdrop of the signals that I track. I look at the length of time the signals have been warning for. And then just kind of logically, it makes sense to me that because there's a lag between interest rates and the economy, we just went through the fastest rate hike cycle in history, and stocks are seemingly largely shrugging it off. If you just looked at the Dow, it hasn't really been a terrible bear market from that perspective. I just find it hard to believe that the delays are not going to start coming to the present now. That's why I said imminent. I think there's a lot more shorter term, intermediate term risk than people realize. That's not to say that you can't go higher. It just is to say that the conditions are there for something bad to happen. So why bother taking excess risk when this bear market is probably going to take some time to play out?
Yeah, I agree, because we haven't seen all the interest rate hikes that the Fed has done priced into the economy yet. Yes, it's hit bonds, corporate debt, junk bonds, things like that. Yes, it's hit real estate in terms of buyers. Unless you have a pristine credit score, you're not being able to borrow for a mortgage at 7 or 8%. Your borrowing costs are even higher than that. So the amount of buyers available for real estate is down. But real estate prices have not crashed yet here in the United States. Now, if you're talking about like Toronto area, I think prices are down 30% in 12 months, but that hasn't happened in the US like in 2007 or 2008 yet. And that will start, the higher interest rates will start to, like you said, a lag. So there's at least 6, 9, maybe even 12 months if the Fed doesn't start lowering rates, where the higher interest rates will start to cause enormous problems in the economy with consumer spending and other asset prices.
Yeah, I mean, it has to, right? It's like, this is what's I think so fascinating about it, because I do think that us being in the industry, we see this, we know this, we understand the role of interest rates. Most people just, I don't know if it's just a function of there's so much capital and cushion that consumers have, but most people outside of our industry seemingly aren't really worried, despite interest rates having risen as much as they have, which is remarkable to me. And again, that could just be a function of there being so much residual excess liquidity that people are not even considering it a real risk. But at some point, the credit cards get tapped out. At some point, the unemployment rises. At some point, the fear starts to kick in. And at some point, again, people will realize just how bad the housing market probably is. Now, to your point, though, and this is why I keep going back to even the housing discussion is tricky. There is a legit inventory issue. I mean, that I think is without question. So you end up having this, I'd argue, this almost strange equilibrium that makes the decline a little bit unusual in that, yes, you have collapsing demand because of high mortgage rates. Yes, cash purchases would probably still take place, but any kind of levered mortgage is not going to be as prevalent as it used to be. Right.
And the
But then against that backdrop, you got low inventory. So it's like you have low demand, low inventory, and people are saying, well, why would I even bother to sell my house now to buy something else at a much higher rate? So you're just not going to have that many comps getting reset lower, would be my argument.
Yeah, it's totally distorted with property taxes and other stuff. I mean, rent increases the last 2.5 years are up in certain areas over 30% in major metro areas. So you have rent spikes. You have a lot of people whose income hasn't kept pace with the government's official inflation rate, and so they can't afford rent. You're starting to see news stories come out of lots of young adults, age 18, even 41-year-olds, starting to move back in with their parents. So, I mean, the distortions cause, you said, lack of inventory. I mean, with rent prices going where they are and people's incomes aren't keeping pace with the increases for food and rent and stuff. So it's, and then there's other stories about people who are living at home with their parents that are buying insane amounts of luxury goods.
Yeah, I had this like strange, it was like strange theory that it's like why was the metaverse all the rage? Because people started to realize that they couldn't afford things anymore and they just needed an escape. All right, it's like if you can't afford the real world, then live in a virtual one. I know that sounds bizarre, but I do think there's some element of truth to that. But yeah, no, and this is the thing about the environment that we're in. People lost sight of what they really need to have a good life. They end up focusing on, with due respect, complete nonsense, bullshit type of goods and services, and they're not affecting proper change in their local societies, right? So for one example, this is, how do you end up having lower home prices? You need to have more homes. Okay, if you need to have more homes, you got to have probably less red tape among municipalities where the home builders are building these homes. Okay, well, that red tape reduction should come from home buyers, not necessarily from those constructing the homes. But people are getting so distracted by all the luxury items, to your point, that they're just purchasing in their mother's or father's basement, that it just reinforces the dynamic that ends up making people unable to actually have their own house.
Yeah, I don't know how this thing is going to get fixed. I just see more government intervention with politicians promising freebies. I mean, free healthcare, free rent. It's not really free. You can ask the people in Canada the income taxes they pay for their free healthcare.
Yeah, I have to tell you, it's it is really remarkable to me. It's like this stuff should be very basic in terms of people's understanding that there is no free lunch, that nothing is ever free, that inflation is often the cost. It's like, for all the talk about, taxing the rich, it ended up being everybody else that suffered the most because it was inflation that they had to get rid of, not, taking billions away from, from those that you can argue whether they deserve it or not, but that wasn't really the source of the problem. So, the inflation is not going to end until stupidity ends from politicians, and stupidity from politicians is not going to end as long as people want the candy.
Yeah, I agree. Especially if the politicians are not going to be there in the next couple election cycles, they can continue to give away free stuff to buy votes, to try to stay in election, or to get deals for their friends and family members, unbid contracts. I want to ask you about the dollar now. We're recording this interview on Friday, December 23rd, 2022. The dollar index is at 104.36. If you think do you think the dollar is going to continue to rally and get stronger? And if it does, what type of damage do you think it would do to the global economy?
So the dollars, had a pretty sizable decline, right? And several weeks ago. And I was one of those guys on Twitter that was being, as I usually am, annoying by basically arguing that the dollar would start to break down as everyone was still worried about it rising. Okay, so a couple of things. One is I think it's not. I don't think it's impossible for the dollar to try and push again towards the prior highs or even make new highs. Yeah, it's interesting, right? The dollar advanced because of concerns around inflation. The dollar then weakens, which is inflationary, right? So either it's a process of normalization, which it could be, or this is just a correction and the dollar is still going to push higher, in which case that's the setup for a sovereign debt crisis, right? Which is something I've been hammering for a while, except that it's always about path, not prediction, right? The when is a function of how it plays out in between the endpoints, more so than anything else. Now, if the dollar were to resume its advance because there is a shortage and because of some other geopolitical risk that probably is out there, and it's funny how these things seemingly come out of nowhere, but just keep on happening time and time again. There is, I think, a non-zero probability that you end up having some kind of credit event in 2023. Now, I'm going to argue that a credit event may be exactly what the Fed and central bankers in general need. The fastest way to get back to 2% inflation is with a credit scare, right? If you just cause because every single credit event is inherently deflationary, more than just disinflationary, outright deflationary. So if you were to have something like that, then the Fed is going to pivot very hard. Even if headline CPI remains elevated, they're going to have to try to reliquefy, which is going to optically look very strange, right? Because they'll be cutting rates as CPI is still maybe above 5 or 6%. But that, I think, is certainly a possibility and probably a risk that most equity investors, at least, are not really fully thinking through.
About 6 weeks ago, the Bank of England had to do something similar because while they were still raising interest rates, they had to start buying bonds, and then they had to bail out pension funds and ask the Federal Reserve Bank for a currency swap line for US dollars. So all those three things happened within, I think, a 48-hour period.
Yeah, and this is why I've said it's like, listen, all year, despite me going through hell with my funds, the drawdowns, again, from a rules-based perspective, it's like, I said all year that this year is worse than 2008, worse than 2020. And I had a lot of people, even to this day, saying, what the hell are you talking about? Okay, first of all, the Sharpe ratio, the risk-adjusted return on the aggregate bond index this year, the risk-adjusted returns on bonds this year is worse than the Sharpe ratio of the risk-adjusted returns for stocks in 2008. So and it relates to the UK because it's ultimately about the fixed income side of the equation. So yes, it's not worse than 2008 in the sense that you didn't have companies going under, but you almost had the entire UK go under. You almost had the entire country go under. If that doesn't make people nervous about skating on the thin ice, I don't know what does, right? And I've made this point too before. It's like, one of the arguments for why the great financial crisis played out the way that it did is because there was mark-to-market accounting. A lot of illiquid stuff suddenly ended up getting priced. It caused people to freak out, investors to freak out, and caused sort of a self-fulfilling selling cycle. Well, I'm pretty certain that if you were to mark-to-market the entire globe and all the assets that all of this leverage is priced off of, given what's happened in bonds, with the UK as the example, this would look way worse than the great financial crisis of 08. We just don't see it because it's not real time.
Oh, I totally agree. SoftBank would be insolvent already because they have look at the tech bust. You have a real estate bust and a tech bust in China. You have Silicon Valley going through hell right now because the majority of their companies are not profitable, and SoftBank has enormous exposure to all those. And the other one is the bank stock Credit Suisse. Those shares are way below $5. You manage money in a pension fund or mutual fund. I don't know your bylaws, but if the shares are below $5, there's a lot of pension funds and mutual funds out there that cannot hold the stock anymore. They're going to have to dump it. So it's going to be forced selling of Credit Suisse shares soon.
Right, and that's why I keep going. That's why I keep going back to it's about conditions. The word imminent was purposeful because the length of time that this has played out is where this really becomes a real problem, and the lags end up becoming the present, right, in terms of how it hits. So it's some people think I'm trying to be some crash caller when I put that thread out on Twitter, and it's like, well, first of all, that's not true because I don't believe in making a call, and I've gotten it wrong many times, and I even say that in the thread. That's why I'm saying it's about conditions more than predictions. But exactly to your point, it's like, do you really want to feel comfortable taking on excess risk in a stock portfolio if any number of butterflies flapping their wings with all of this leverage and all of these dynamics could create a hurricane? My response would be, if you're an asset allocator, probably not. Now, this relates back to the flight to safety dynamic. Right, because I'm biased. I actually want to see some of those tail events in equity, some of those real extreme declines, if some of those crashes, right, to the Treasury's benefit, hopefully.
Are you allowed? Are there there's strict laws though, like you said though? So all asset allocators have different laws about how much cash they're allowed to go to. So different portfolio managers can't go to 20, 30, 40% cash. They can't buy more than a tiny percentage of gold exposure. So a lot of these guys are trapped.
Yeah, I mean, I think yes, correct conception. I mean, You always have like independent financial advisors, but that's obviously a smaller portion of the industry, right? That would be more cash or would have more flexibility. But but you're hitting on something which is actually something that is really underappreciated, and I see it from a portfolio manager perspective with my funds. Most institutional money, which is the big money, has mandates in terms of, to your point, how much they can be in cash or what they can or can't do. So yeah, it's like people seemingly think, especially on social media, that it's an easy fix. All they need to do is just sell their assets and have more cash cushion. They literally can't, right? Because it's a legal contract that they have with their constituents, with their clients. In my case, with a prospectus. So, and that's why this ends up being almost sort of a situation where even if you conceivably argued that it's an easy fix, you really can't because of the restrictions around how that institutional money behaves.
Yeah, it depends how much restrictions and what's in your prospectus and your bylaws. So these hedge fund guys, a lot of them have had to change what their lockup is, and then for long and short and things like that. So they have to be careful because you could have drawdowns at the wrong time.
Yeah, it goes back to path matters more than prediction, right? And that again, I keep going back to. Let's go back to what I said earlier, right? So this is the only time in history treasuries have lost more money than stocks in a top 20 drawdown. The assumption there is that the drawdown for stocks is over. Well, what if it's not? What if you end up having a cascading sort of margin call, as these institutions now have to meet, collateral calls, capital calls. So if that happens, stocks probably go a lot lower, meaning you break the lows of 2022, the drawdown becomes deeper. And maybe in that case, treasuries then again counter, at least during that second wave lower in equities, meaning that in the fullness of the equity drawdown, treasuries might still look like the better flight to safety trade. It just didn't happen in the first go round.
So I want to get your thoughts on what Felix Zulauf has been saying. For our listeners who are not familiar with him, he's a well-respected money manager, manages many billions of dollars, or at least he used to. And he was on the Barron's Roundtable for many years. He is predicting more asset price volatility. He called it a roller coaster and shorter boom and bust cycles. Do you think that that's kind of the environment we're going to be stuck in for at least a few years going forward?
So I think it's possible. And, listen, you can argue that happened in a lot of other parts of the world, in particular emerging markets, right? I mean, if you look at broad-based EM emerging market indices, it's been a roller coaster. Just I call volatile cash, right? Really, just not going anywhere with a lot of big swings, peak to trough. And it's interesting, right? Because the U.S. was the standout for the last decade, largely because of QE. You don't have QE now, so I think that's possible. I would take it a step further, though. I think that this is going to be a very, very difficult market, almost perpetually, because now you've got all this manic volume trading and activity in 0 days to expiration options. You have all of this manic trading because of commission-free brokers. You're in an environment where there's so much more noise than probably ever before, just in price movement, because of the ease with which people can speculate, right? Both individuals and institutions. That I think that just creates in general a very frustrating environment for buy and hold.
Yeah, I agree. So especially if you're long basic things like a stock mutual fund or one of those passive investing general stock market ETFs. So the index fund investing, that has created enormous distortions and a bubble because it allocated way too much capital to the FANG stocks.
Right, exactly right. And that concentration risk now is coming to pass. I mean, we saw that with some of these names, but a lot of this still has to get unwound. Look, I mean, Tesla's been, utterly taken to the woodshed this year, and yes, you can argue that's partially Musk, but I'm going to argue that's also largely because of passive automatic fund flows, right? And Tesla benefiting from the market capitalization weighting of the Nasdaq, of the S&P. You're probably going to see more of that. Maybe not as synchronized as one might expect, but it wouldn't surprise me if a lot of this incredible performance in the FANGs gets unwound in the next several years completely, like a total round trip.
I think we could also see a lot of people, because either they're cutting back, their businesses are hurting, maybe they lost their job or their income's falling, they're being asked to take a pay cut to keep their job. You're going to start to see people liquidate some of those retirement accounts. They're going to take the tax hit because they need the cash.
Yeah, maybe. I mean, look, in general, you have a period of divestment, right? Just because of baby boomers retiring anyway, right? I mean, you can argue that the baby boomers have to come back in because of high inflation. Okay, fine, but the reality is that that's going to be sort of I think, some pressure in general on asset prices, which is why expected return probably is going to be low for some time for U.S. markets. And it's also overinvested. I mean, look, you can't blame allocators for being largely in the U.S. It's been the only place where momentum has existed. You try to go international for the last decade, you got fired, within a year or two, because you couldn't keep up against the U.S. So, and you had this kind of, I think, broader sense of, if you can't beat them, join them. So a lot of money just went into U.S. large cap averages because it was the only game in town. It's very hard to beat the S&P when the S&P is it, right? When the S&P is the leader. But then at some point it gets unwound. And, to your point, if you're going to have higher unemployment against stickier inflation and no real income, what do you do to survive? You have to sell assets.
Yeah, I think that's where we're heading, unless something turns around, but we'll see what the Fed decides to do, how quickly they start lowering interest rates, how quickly they start expanding their balance sheet again. I really, there's a math problem coming in 2023 with interest payments on the federal government debt.
Yeah, and it's like I had joked about that before. It's like the Fed's going to have to restart QE just to pay for the interest expense that higher rates are going to cause on the U.S. government. I mean, the whole thing is just utterly bizarre. That's also another thing why I don't think, all these arguments around the end of the 40-year bond bull market, to me, don't make any sense. It's like, it can't be the end of the 40-year bond bull market unless you've ended the 20-year spending binge by the government, right? And unless you stop wars, right, which is where a lot of the debt also comes from. I've made that point before. It's not a conspiracy theory, but the size of the Fed's balance sheets around $8 trillion. The estimated cost of the Iraq war was $8 trillion. I find that to be an odd coincidence. So it's hard to imagine a situation where, bond yields were to keep rising at the same time the government is still spending, because how the hell is the government going to finance that if at some point your interest expense is more than your taxpayer base?
Yeah, not unless they start going after people's retirement accounts or 401ks and the IRAs and forcing people to hold treasuries as a mandatory, which is actually, if you study financial history, it's happened from governments in the past. During a war, they forced the citizens to buy war bonds and confiscate funds to fund the war.
Look, if anything if this year has taught anything to anybody, it's that nothing should surprise anybody anymore. I mean, the fact that you end up having politicians trying to fix inflation with more money.
Yeah.
Right. And it's not a political. It's both parties. I don't give a damn what anybody says. It's both parties are like this because, to your point, like you said earlier, that's how you get elected. You promise more. Wow, you're not promising more with austerity. You're promising more by spending.
Yeah, I live 20 minutes outside of Washington, D.C. for over 20 years, both political parties. So the Democrats are tax and spend, and the Republicans are borrow and spend.
Yeah, I think there's a lot of truth to that. So my point is, like, given, we're in like bizarro worlds, right? Even from an asset class perspective, we're in a bizarre world. You look at conservative asset allocation, which is overweight bonds. It did worse this year than aggressive asset allocation portfolios. Conservative performed worse than aggressive because conservative had more bonds, and bonds got smoked relative to equities, even though equities are last in line on the balance sheet. I mean, what has a higher claim on assets? It's debt, right? So, again, nothing would surprise me. I certainly hope that that's not going to be the case, because I think you'd have legitimate, screaming. But keep in mind, confiscation doesn't have to happen, through the government taking money out of your 401ks or your IRAs or your retirement accounts in general. It can just happen with inflation.
Yep, they can. Well, historically, governments inflate the debt away when they get into these types of debt problems. So normally, the large developed countries don't default on the debt; they inflate the debt away in nominal terms.
Yeah, and that's kind of the. I mean, for all we know, that's what we're kind of going through right now.
So I want to ask you about gold and commodities, because I just hear every day demand destruction, demand destruction, demand destruction. At some point, with inflation and supply chain problems in the system, I just see with a lot of these businesses, costs just keep rising. So do you think commodity prices can keep going lower? I know you mentioned lumber. So it looks like lumber would be a commodity unless it gets to a certain price way below the cost of production. But it looks like a lot of these commodities Do you think there's going to be a long bear market, or do you think this is going to be a shorter cycle and they're going to have a higher price floor based on all these cost pressures?
So I'm a believer in the underinvestment point, right? That across the board in commodities, right? That there's been a lot of underinvestment, and that should be supportive of prices because available supply takes time to release. So it's got to be much more demand driven as far as the broader weakness. The thing is, commodities, as you know, are volatile, and it's not like you can necessarily have commodities as a buy and hold investment that easily. You can have it in a portfolio for other reasons, but it's the same dilemma, right? Neither lumber nor gold nor anything else, pays a dividend, pays any kind of income. That's always been the criticism. And it's funny also that just being in the asset allocation advisory side of the industry, people only consider commodities an asset class in a portfolio when it's performing well, right? Otherwise, if it's not in an uptrend, it's not an asset class to consider. If it's in an uptrend, it's an asset class to consider, right? Against like a 60-40, then you include some commodities in there. So I'm saying all that because yes, I think commodities probably have a higher floor than they've had before. But if big money believes that the trend is going to keep going down, they no longer consider it something as part of their asset allocation, and that also creates a swell of selling, right? And the truth is, I've made this point many times before. It's like with all these supply chain disruptions and all these narratives, there's a lot of stuff out there. Waste is kind of a problem, right? And one way to solve high commodity prices, except in the case of oil and gas, obviously, is just people using used things instead of throwing out a couch and then waiting for something to come from China in 6 months.
Yeah, there's a lot of big name investors like Warren Buffett, David Einhorn, even Kyle Bass. I heard on a recent interview talk about how they're starting to look at oil and natural gas companies as really good buys, good value opportunities with good growth because of the underinvestment from so many different countries. I mean, the solution for a lot of these politicians was to put windfall profits taxes on these oil and natural gas companies or put price caps on what the companies can charge for electricity, which is not going to fix any of the supply problems long term.
Well, I'd even argue it would make it worse. And I'm saying that because, look, every single round of increased taxes, if you ever notice from any politician, whenever they talking again, and I know it's mainly Democrats on the increased tax side, but whenever any politician talks about increased taxes, it's never used to pay down debt. It's used as justification for more spending, for the incremental spend. So you got a windfall tax for oil and gas companies, and the argument is that that's somehow going to break inflation. Well, yeah, but if they use that windfall tax to then do some other stupid Inflation Reduction Act, which throws more money at the problem, then them taxing and quote unquote punishing oil would actually be more inflationary than the price gouging that they believe the oil companies are putting through the system.
Yeah, I agree. In the short term, it might knock the prices down so the politicians can win an election or re-election. They're going to, if they do the windfall profits taxes here in the United States, which they're talking about, they would try to allocate some of that or force companies like Chevron or ExxonMobil to allocate to ESG, so solar, wind, biofuels. That's wasting a lot of those investments. Look at Germany. They've had enormous, many billions of dollars in waste that could have been allocated to more supply for oil and natural gas.
Right. No, I think that's right. But keep in mind, it's like there's a difference between relative and absolute returns. So you could have energy be a secular winner from an investment perspective, but that could mean that it's down 30% while everything else is down 50%. So which would be a huge win, but it's still down 30%, right? So I think that's an important consideration.
In that environment, though, does anyone actually increase their net worth, though? I mean, I guess Wall Street banks or money managers who maintain a certain amount of funds under management, they're charging high fees. But in that type of environment, it doesn't sound like anything's going to do well.
Well, again, except historically, it would be treasuries because it means yields would drop on the long end, right? In that flight to safety recessionary environment. I mean, that's typically what you see. So you haven't seen this year, right? But again, who knows? If the drawdown dynamic is over, but you're largely correct, right? I mean, that's just the reality. And it is, look, there are always going to be times in history when you're investing that there's nowhere to hide. I mean, this year, yes, you can argue oil, energy stocks were clearly the place to hide. I'd argue actually it was utilities as a sector. That was really the best place to hide as an offensive proxy. But if you end up having everything have another wave lower, a tail event in risk on assets, the only place you can probably hide in would be what you intellectually would rather not do, which is giving it to the government, at least for a moment in time in terms of bonds.
Well, the financial history, we talked about this earlier, you did, and I agree with it because I brought it up in the past too. So you have dollar historically in a bankruptcy, credit risk environment, insolvency environment where you have private sector businesses. So the major one here in the US is the post-October 1929 crash and the Great Depression that lasted through 1937, although the government did double the amount of debt and did try to create a lot of inflation, and it didn't really work according to the US Treasury Secretary at the time. But there were tons of bankruptcies. So dollars, US Treasuries, and then also gold. Those would be the main ones. And gold's starting to catch a bid here. I mean, it's by no means breaking out enormously, but it's also not falling a lot either.
Yeah, and I keep going back to this point. I keep referencing other conversations I do. I mean, I think gold really ends up probably standing out and getting some momentum the longer the bear market and equities last. And I say that because from an asset allocation perspective, gold really doesn't correlate to very much. So it's kind of the ultimate diversifier alternative hold in a portfolio. But in order for there to be a desire to have more non-correlation, you have to have some entrenched belief, especially by institutions, that the bear market will take some time, that they need to actually diversify beyond just the number of instruments in a portfolio and more towards, kind of non-correlating assets. And there aren't that many, right? Gold, again, is among them. So if you end up having a prolonged equity bear market, as I suspect we're in, and again, I could be totally wrong, that should be at some point very supportive towards gold momentum, because all you need is a few allocators to start buying it and pushing the price higher to then have the sort of self-fulfilling momentum cycle that's needed for it to really work.
And a lot of the really big money, the institutional investors, don't they have 1% or less allocated to gold?
Yeah, which makes sense, right? It's like I go back to, allocations have a funny way of rising after something's already risen.
It doesn't pay if you're a large money manager, doesn't really pay to be contrarian because you're sticking your neck out. And if you're wrong, and if you're wrong, then you're going to have huge drawdowns. They're going to call for your job. The amount of assets under management is going to collapse. So if you're wrong on a contrarian call, you make a big bet.
Yeah, and I'll even relate that to my world from a fund industry perspective. So I've got 3 funds. The turnovers on all the funds are very high. They're very, they're systematic. They're rules based. They have a very, very different return stream. They've all gotten slammed this year. I'm hopeful that that's now over. But, so why did I create the funds the way that I created them? Because I have to stick my neck out with something very different in order to stand out against, all these competitors, because all these competitors do exactly what you just said, which is they stay around the middle. They hug the benchmarks. They basically are trying to, be like the S&P, because you don't get fired if you're in the middle, right? So, and you also can't grow if you're in the middle. You have to take a chance, right? So, being contrarian pays off in a big way, and I don't, if it works, obviously, and I'd argue that because there's so much availability of different products that basically do the same thing, the only way to survive is to be contrarian. You can't grow any other way.
So your ETFs, do they have gold exposure then, or how are they being contrarian exactly?
Well, no. So the RORO ETF uses lumber relative to gold as a signal for when to play offense and defense. I mean, the amazing thing this year is that, you look at lumber all year, it's been weak. You look at lumber relative to gold, obviously been weak all year. That fund's been largely defensive. The signal's actually been correct to say, be careful, volatility is going to rise in equities. But again, Treasuries failed as the expression of that for the first time in history. Hopefully now that's over. But I view gold more from a signal perspective, because again, it tends to act like a risk-off commodity. So it's worth paying attention to just from that standpoint. From an asset allocation perspective, I go back to that point. I think gold makes a lot of sense as a diversifier, as long as the environment favors the true diversification, which means non-correlation.
Do you also look at the oil to gold ratio? Because I know a lot of people also look at that one too.
Yeah, and it's a little bit of a similar story. I mean, to the extent that you can view oil as a risk-on asset, I think there's some aspect to that.
Well, economic wouldn't oil be more about economic growth though? That the consumer is using more, there's more traveling.
Yes, but lumber is more of a tell because of the what it means for credit creation through the mechanism of housing, right? It's like that. That's the whole the copper, oil, lumber, these are all no disagreements. These are all leading indicators because they tell you about economic activity. But really only lumber tells you about the potential for credit creation and expansion because of what housing does for credit creation and expansion.
I see. So do you expect then lumber to continue to be weak in the near term?
Yeah, it seems like it. I mean, if lumber prices could fall another 50% from here, from where they are now, and that would just get it back to its kind of historical range on the low end. So, lumber had a really outsized move, obviously, post COVID. A lot of that was largely driven by sawmills, right, and kind of the disruptions there. But lumber is still kind of in a pretty deep downtrend. And that, again, would suggest that housing activity is going to really come to a halt.
Wasn't there also a one-time boom over a 12, 18-month period where a lot of people stayed at home during the pandemic, and then they were doing a bunch of home improvement projects on their own?
Which pulled forward a lot of the activity. Right. I think that there's no question that there's an element of that. And there were other complications with tariffs that Trump and then Biden kind of factored in when it came to Canadian softwood. But my point is that, the reason I focus on lumber so much is because it's a better real-time tell on the state of housing than looking at Zillow. And from that perspective alone, it would suggest that, housing's in far worse shape than people think, and can get a lot worse because you're still not sort of in the historical range of what lumber prices should be at.
Last question before I let you go. So Bitcoin actually correlated very heavily with the NASDAQ. And I would argue that Bitcoin was a risk on type of speculation rather than the safe haven that a lot of people say, because a lot of people didn't read the Satoshi Nakamoto white paper and weren't buying Bitcoin because they don't trust the government or central bank. They were buying Bitcoin because it was in an uptrend and they were hoping that they were going to get rich quick. When it went to 40,000, the price targets that I was just seeing with people, that when it hit 60,000, oh, now it's going to 150,000. Now it's going to 200,000. And that to me just set off a lot of alarm bells that people were buying these, were speculating on Bitcoin and not buying it for the right reason, that it was going to top. So do you think then that Bitcoin's going to be in a prolonged bear market for the next couple of years?
Yeah, the thing about correlations, as you know, is that they can change, right? So if it stays correlated to equities, which, I think makes sense to your point, it acts more like a risk on asset, then, then it would stand to reason that it's probably going to be a bear market for a while, because I myself believe that equities are probably in a bear market for some time. But the correlation can also break. I mean, it's not clear to me what would be the catalyst for that. But it's, again, I go back to nothing should surprise anybody at this point. So, look, it's like everything else, right? Bitcoin is just wildly volatile. It's in a lot of ways good to see a lot of the scams and frauds, get destroyed here, even though it's unfortunate, obviously, that a lot of innocent people, and we can debate whether it's innocent or not, or naive investors got very hit by it. But, you cleanse the system, that's good for everybody longer term. And I think cleansing the cryptocurrency space is probably good for Bitcoin, you can argue, but it's still going to be a volatile asset.
Yeah, I agree. I think a couple years from now it could rebound, but it has to work through all those accounting fraud and all the problems with the exchanges and Tether, and from just reading the stuff about the hedge fund managers, they're going through the financial disclosures and the bankruptcy filings. There's going to be a lot more problems at the Bitcoin exchanges and Tether and the Grayscale Bitcoin Trust before Bitcoin has a chance to rally.
Yeah, and you need to have regulation. I mean, which is unfortunate, because that was sort of one of the beauties of blockchain technology and the space in general. But yeah, I find it hard to believe that you're going to have any institution with any size take Bitcoin super seriously, not because of a mistaken notion that it's like shitcoins, right? Which obviously it's not, but just because of the optics of it, right? You probably need to have some degree of regulation.
There's going to be lawsuits and heads rolling. I mean,
exactly.
the largest pension fund in Canada, with the Ontario Teachers Pension Fund, didn't they invest $400 million into FTX, or one of their subsidiaries did, and they didn't even know about it 12 months ago or something like that.
Right. And like the reality is, like, underlying investors, the mom and pop investors, they're not going to be able to understand or even think about there being a distinction between Bitcoin and shitcoins, right? To them, it's all the same. So that's what I'm saying. The optics of it, I think, make it hard for institutional money, even if the narrative is wrong, to really get comfortable again, which was one of the real reasons and catalysts. It was argued that Bitcoin would go to the moon, well, now you're grounded.
Yeah, once those Super Bowl commercials hit in February 2022 with all those crypto companies and exchanges that were unprofitable, it just reminded me so much of the top of the tech bubble.
They agreed, and I mean the real tell for me was the laser eyes, right? It's like that's why I put lumber and gold eyes. That's why I started saying few understand this ad nauseum on Twitter, because that's what the Bitcoin maxis would say, and it was so obvious with hindsight. So I almost turned my Twitter account into kind of a hybrid of sarcasm, poking fun at all these narratives around cryptocurrencies, and with a mix of some seriousness and loud jokes. So it's like people seeing my account really don't. If you do understand that I'm actually being sarcastic, the bulk of the time. But yeah, all this stuff was obvious, not even in hindsight. It was obvious.
You say few understand this a lot. I think you're definitely being sarcastic there.
Yeah, it's funny. It like triggers people. It's like I have fun with it, but it is remarkable to me. And this is just a kind of a broader comment about society. It's amazing to me. I keep using that line. Amateurs look to the right of the equal sign. Pros look to the left. It's amazing to me how we've gone to a point in society where nobody ever thinks and stops, and they just react. Right? Even like that thread that you mentioned on the crash, right? The imminent crash. I put that out December 2nd or 3rd, I think it was. The first tweet in that 20-tweet thread had, I believe the conditions favor an imminent stock market crash. Then I said a thread. That first tweet had 4 million impressions organically on Twitter. The second tweet in the thread, which goes deeper into why I said it's not a call and why, I believe the conditions are there, only got 250,000 views. So I go from 4 million on the first headline to only 250,000 on the second, and then even lower as I go deeper down the thread. So it's just, this is the most toxic part about the modern era. Nobody ever takes a deep dive on anything. That's an opportunity for true investors that do. It's also wildly maddening if you're trying to build a social media presence.
Yeah, and there's opportunities to do more research and be a contrarian. It's not always going to pay off. So probably contrarian opportunities are what? Gold, oil, natural gas and the weakness, and then uranium. So there's and then fertilizer plays too, with how much fertilizer capacity is offline in Europe and the United Kingdom. So there's opportunities in commodities, and then also maybe for a short-term trade for US Treasuries, unless the US government is like hell-bent on inflating the debt away even faster than normal.
Right. I mean, it's the flight to safety trade. I mean, the commonality across all that is, it's a general rule of thumb for any investor, right? The best investors buy dislocations and they sell normality. So look at where the dislocations are, and don't be afraid of it, and don't attack those that are creating strategies, that happen to be in the dislocation. Rather view it as an opportunity, because those dislocations, when they occur, are pretty rare.
Yeah, I think we could have a pretty bright year in 2023 for gold, silver, platinum, and palladium. They're starting to look pretty good on the charts. Now, we haven't had big breakouts yet, but there is a slow accumulation of dip buying in the charts.
Yeah, I don't disagree. Look, I keep going back to diversification is exposure to as many different future paths as possible. So commodities are, exposure to a certain kind of path. Stocks are exposure. My own funds are exposure to a certain kind of path. Nobody knows what path is going to play out, but you want to have at least some exposure to it in case one of them hits.
Well, Michael, I really enjoyed our discussion today, especially since you manage money and get your thoughts here on drawdowns and all the crazy, you have to deal with all these bylaws and prospectuses. The average person listening to this podcast doesn't understand that, because they think that you can easily move money into gold. And why aren't you doing this? Why aren't you going to cash? I'm sure you get this a lot, like people saying, you're stupid. Why didn't you go into cash? Or why didn't you buy this? Or why didn't you buy some Bitcoin? Or what? And you, as a professional money manager, you just have to deal with all these rules and restrictions.
Yeah, but I'll tell you something, like, that's true, and that hurts in a year like this year. Okay, with hindsight. Okay, again, I go back to, you could have argued stocks and treasuries would lose money this year, but saying that happens is different than saying how it happens, right? The interaction, the sequence. But restriction can also be helpful in the sense that, if everything's ultimately about cycles, restrictions keep you in the same type of an approach for when the cycle eventually comes to you. The problem, just intellectually, with also just being discretionary, it's not really a problem, it's just a different dynamic, is that, okay, so you're discretionary, but then the cycle you don't realize the cycle's changed until 2 to 3 years after the cycle's changed. And then you adapt. Whereas if you had your restrictions and your rules in place, even if the cycle changes, you're automatically starting to work in it.
And I think we're going to have a lot shorter cycles now based on what governments and central banks are doing. They're just so desperate. They're going to start pulling levers. We're in like the end game of Keynesian economics here.
Yeah, well, as long as it's not the end game, right? The end of the world, which I've said is the bull case. Right? I mean, look, I always go back to that quote from Charles Dow. The one fact pertaining to all conditions is that they will change. As long as you focus on conditions and then speed up or slow down as the conditions change, hopefully you'll be okay.
Well, it'd be nice if if there was an end game for fiat currencies, but I don't think those are going away. And it looks like central banks are looking at even more nefarious things in the not too distant future with central bank digital currencies.
Yeah, well, I might have to save that for another conversation too.
Yeah.
And I might need some alcohol when I start talking about that.
Yeah, it's I don't I've been covering those since 2015, 2016. It's not fun to be talking about those. Well, I appreciate your time, and it is a holiday, so happy holidays everyone, and thank you so much, Michael, for coming on and spending an hour talking about markets and how you manage money as a professional money manager in a crazy roller coaster environment with asset price volatility and rapidly changing government and central bank policies.
Yeah, no, I appreciate it, and thank everybody for listening.